Okay, in this video, we're going to go through equity disclosures. So we'll go through an example company and see how they disclose their details of their equity activities. So the company we're going to use, we'll get to in a minute. But first, I just want to give you a slide of definitions. So you're going to see some terms on in this company's financial statements. And I want you to be able to reference this slide for all of these, where I define all of these terms. Okay, so you can pause on this and read it more carefully. I'm not going to go through these very carefully. I think what I've written here kind of explains itself. So we'll go through the actual company's financial statements and we'll talk about it there. And the company we're going to use is FactSet Research Systems. Okay, FactSet is a company that provides data to investors. So they collect and disseminate data about, potential investments. So company data to investors, and then that information helps investors make good investment decisions. Okay, that's what FactSet does. Okay, that's their business model. And they're a public company. So they said, okay, this is a good business model. We're going to go public and we're going to raise equity capital from the public capital market. And we're going to track it primarily on our balance sheet in the section called stockholders equity. Okay, so this is on the balance sheet of FactSet in the stockholders equity section of that balance sheet. This is for the year ended August 31st, 2019 and 2018. And let's start at the top. The top line is preferred stock with a 1 cent par value, 10 million shares authorized, none issued. So this, I'm going to kind of gloss over this, right? Preferred stock, there's none of it issued. And there's none of it outstanding. So they have their charter allows them to issue and sell preferred stock to raise capital that way. They are authorized, but they haven't yet raised capital by issuing this stock. And so that's not really an issue yet for FactSet. Okay, the longest line item is the next one, common stock. So if you participated in the IPO for FactSet, or you have an E-Trade account and you want to own a part of FactSet, you own some of their common stock. That's what you own, okay? Certificates of their common stock. And those, each share, okay, has a 1 penny par value. And that is an almost meaningless statement. The par value is not really used for anything meaningful other than to track what dollar value goes into this common stock account, okay? And we'll go over that in a minute. But each share of common stock for FactSet has a 1 penny par value, and that's just written somewhere in their charter. Okay, how much common stock is authorized in the company's charter? 150 million shares are authorized. So that's how many shares, without changing their articles of incorporation, FactSet can issue and sell up to 150 million shares of their common stock. Have they sold all those shares yet? Nope, not yet. So here's how many shares they have issued as of 2019 and 2018 respectively. So let's just talk about 2019. So in terms of shares, so let me erase this circle here. In terms of shares issued, how much as of 2019 is this number here? 40,104,192. That's how many shares are issued. What does issued mean? Well, if you go to the previous slide, it means that at some point in time, FactSet sold those shares to some external third party out in the marketplace, okay? So they've sold 40 million shares in some time in the past, okay? So how is this common stock account determined for accounting purposes? You take the number of shares issued, 40.1 million, and you multiply by the par value of shares, 1 penny. So if you multiply 1 penny by 40 million, this is what you get, 401,000, okay? And so that is just the amount that is credited to common stock. Any amount that you raise, so if you paid FactSet more than a penny for your share, okay, they raised more than a penny, any amount that they raise over and above that par value is just credited into this additional paid in capital account, which has a much larger balance of 806,973,000, okay? So in terms of shares issued, that's the amount that goes in the common stock account. The next number is shares outstanding. So let me erase some of these lines here. Now we're going to talk about shares outstanding. And as of August 31st, 2019, FactSet had 38 million shares outstanding. This is less than 40 million. What does this mean? It means that over the company's lifetime, they've issued, of that 150 million shares authorized, they've issued, sometimes sold into, at some point in time, sold into the market 40 million, but then they've bought some back since then. So only 38 million are still outstanding out there trading in the market as of August 31st, 2019. They've bought some back. And as we'll see, the amount that they've bought back is in treasury stock. So you can see the difference between 40 million and 38 million is around 2 million, right? Well, that's what they have in treasury stock. That's the difference right there. And treasury stock, you'll see, has a negative balance in the statement of stockholders' equity. That's because when they buy it back, they pay cash. They credit cash and they debit treasury stock. And when you debit an equity account, that's reducing an equity account. And so this equity account has a negative balance on average. Let's think. One thing we could do on this statement is compute what was the average price they paid to reacquire their treasury stock. Well, you could just take the balance in the treasury stock account. That's the amount of money they paid to acquire treasury stock, and divide it by the number of shares that they're holding. And that will give you the average price that they paid to acquire their own stock. And in many cases, that's called a repurchase. So sometimes in the news, you'll hear that firms repurchase their own shares. And that's what treasury stock is referring to. FactSet has repurchased some of their own shares. Next one down, we see we have the retained earnings account. So retained earnings increases with net income and decreases with dividends. And finally, they have their accumulated other comprehensive loss. Now, sometimes we'll call that AOCI, accumulated other comprehensive income. The only time we've talked about that account in the past is when we talked about available for sale debt investments that companies make, okay? So their AOCI account has a negative balance, which is a debited balance as well. So there's the balance sheet, the equity section of FactSet's balance sheet. Now we'll move to their statement of stockholders' equity. And what this does is it takes all of these balance sheet accounts. So these accounts all come from the balance sheet. And you can see they're listed across the top here. In terms of treasury stock, common stock and treasury stock, not only do they give you the dollar values in those accounts, but they give you the shares, the number of shares that are sitting in those accounts. And what the statement of stockholders' equity does, it's actually the statement of changes in stockholders' equity, as you see up here. So it shows you how did that balance on the balance sheet go from its beginning of year balance to its end of year balance. So you should be able to tie all of these numbers directly back to the balance sheet. And this statement just shows you, well, what happened during the year in terms of equity transactions. And let's just, I guess, start from the top and work our way down. You see that the company had net income. Remember, net income gets closed to retained earnings. So there it is, being closed to retained earnings, increasing retained earnings. The next one down is other comprehensive loss. So remember, these are just transactions that affect OCI. So this is, you can see that this minus 51 is becoming more negative during the year. So what could be an explanation for this minus 23? Well, in terms of our class, the only thing we've learned is available for sale debt securities. So suppose the company had losses, unrealized holding losses on their available for sale debt investments. That would get deferred in this accumulated other comprehensive loss account, okay? So that could be a reason for that account becoming more negative. You could figure it out exactly what it's about by reading more into the financial statements, but let's move on to the next line item. Common stock issued for employee stock plans. Okay, so if you're an employee of FactSet, in some cases you'll get compensated with stock of FactSet. Okay, FactSet will actually give you their shares instead of giving you a cash salary, or in addition to giving you a cash salary. And you can see that they issued 753,942 shares. And multiply by a penny, right? And that's $7,000. And the rest, so employees participate in this plan. Oh, so this is an employee plan. Employees can participate in it, and they pay a discounted price for shares. So employees actually pay for these shares, and the amount that they pay is this total here. It gets divvied between the common stock account and the additional paid-in capital account. Now, what I was originally talking about with compensated with stock is the next line down. Vesting of restricted stock. Okay, so employees earn compensation in terms of the company's stock. And how much did they earn? 85,401 shares. That has a par value, rounded up to $1,000. And did they pay for that? No. Employees did not pay for that. They worked for that. So rather than getting cash, and increasing additional paid-in capital. So let me erase this. Rather than getting cash and increasing APIC like we did when employees purchased the stock, we actually just subtract that out of additional paid-in capital because we're just giving the stock to their employees. Okay, and by the way, they're using some treasury stock to settle their restricted stock obligation there. Okay, the company did a repurchase of common stock, so you can see that the shares are moving into treasury here. The number of shares, 882,000 shares. The amount they paid for it is $213 million for that repurchase. When the company recognizes stock-based compensation expense, right, the expense itself reduces net income. And then also that expense, where does it come from? Well, it's not a cash expense. It's just put into additional paid-in capital as a credit to additional paid-in capital and a debit to stock compensation expense on the income statement. So it's just actually a reclass between these two circles that I'm starring. Okay, it's just a reclassification. It doesn't affect total equity. Okay, finally, the company declares dividends. Okay, so that's going to reduce their retained earnings balance. Remember, retained earnings increases with net income and decreases with dividends. So there you go. We've gone through the statement of changes in stockholders' equity. And just as a final thing we'll do is we'll trace some of these numbers to other financial statements just to see how they all flow through. So we'll go to the cash flow from operating activities. And the one thing I wanted to show you here is, remember, stock compensation expense is a non-cash expense. It's reducing that net income number, remember that $352,790, and we add it back to arrive at operating cash flow. That $32,400,000 is added back. So there's just another place that you can see that stock compensation expense on their financial statements. Then we'll move down to the financing activities. We'll see that dividend that they paid, right? We'll see that they did the repurchase of common stock. This is all the cash amounts. Okay, debt isn't covered by equity, right? Debt is different from equity. But here's those proceeds from the employee stock purchase plans. That's when the employees purchased stock at a discounted rate. That was a cash inflow. As you can see, this is a positive number. And that's pretty much all I wanted to go through. So that's just showing you where some of these equity transactions show up on the statement of cash flow as well.